So if you made it this far to the video, it's because you're actually interested on how banks trade money in the Forex market. So I'm going to go ahead and walk you guys through as simple as possible so that we guys can get a well understanding of what institutional trading really is. So before we get into it, I want to let you guys know the overall difference between technical analysis and institutional trading. Now, the technical analysis is supported by several things, which one of them is going to be understanding our overall market structure. So it can either be bullish or bearish. So in this case would be a overall bullish market structure. And then a bearish market structure would be looking somewhat like this, where market is creating lower highs and lower lows on a bearish market structure. And on a bullish market structure is when market is creating higher highs and higher lows. Now, another thing that a overall retail perspective view is going to be supports and resistance. Resistance levels are going to be sections in where market typically likes to go ahead and tap in several times, which is going to be more than 2 times. As you guys can see, 1 to 2 times and several times. That's going to be a nice area of resistance that you may be taking consideration for retail perspective. Now, so areas of support are going to be sections in which the market is tapping in on the bottom side. As you guys can see in this section, market is tapping several times, 2 or more times, and that is going to be a section in which it is considered as a nice support level. Now, reasons why I particularly don't like to take this in consideration is, one, I like to look at things as a institutional perspective. Now, when it comes to an institutional perspective, you want to understand that banks are here to make money. And if they're here to make money, you want to understand that they are going to do what they have to do in order to make money, meaning that they are going to go ahead and take your money away. Now, one of the easiest, most convenient ways for them to take money away from you is by creating these areas of support and resistance. Now, you may be asking, well, isn't the market losing money by doing that? To an extent, they are, but it is considered just as a drawdown because they are not looking to hold that trade for a long period of time. They're just looking to do that until they have created enough liquidity, which is provided by you guys, the retail perspective, because all your guys' stop losses and all the retail perspective stop losses are either above the resistance levels or beneath the support levels. So typically what market does, and the institutions and banks, they like to go ahead and create these pockets of liquidity. And that is why banks like doing that, because it goes ahead and incentivizes you to make some early profits, but at the end of the day, they are going to do what they can to wipe you out. Now, what do institutions base themselves off to? Now, what institutions base themselves off of is going to be off liquidity zones. It's going to be off imbalance zones, points of interest, and overall manipulations that are created for certain reasons. So for example, if we were to see that market is going to the upside, market will be doing this. So it will be slowing down eventually. And when it starts slowing down, one of the things that they go ahead and do is they create this liquidity right here. So they create 2 types of liquidity, which is going to be that first liquidity of our resistance and our second liquidity, which is going to be our overall open liquidity created by a trend line. Now, what does this do? It incentivizes people to see the trend line, so they're going to continue on buying. Okay, they're going to continue on buying. Now, at the same time, what's going to end up happening right above this section, retailers are going to go ahead and put buy stops, meaning that if they put buy stops in the market, their executions are going to open as soon as market reaches above that section. So there's already people prepared for looking for overall continuations to the buy-in. And also in this section, people are already looking to be selling as well because they see that it is a great resistance level. So at this very point, what they are doing, they are accumulating both sides. They are accumulating both a bearish side and also a bullish side for them to go ahead and create money. Now in this case scenario, if market goes ahead and does this, which is what institutions will eventually do, they'll go ahead and do what is possible to go ahead and push the market to the upside. For what? So that way your guys' stop losses for the people that are selling are taken out. But not just that, at the same time, the buy stops are executed, and now the buying positions are located in this section, so therefore they have been executed. Now, many people will say, well, if the buy stops have been executed, aren't they making money? To an extent, because understand that this is a simple manipulation to take out the liquidity right here, and later they will go ahead and attack the liquidity down over here. So therefore, they will go ahead and do that quick move of manipulation to the upside and then spike down, meaning that at this very point, now they have taken out both plays of the selling scenario and the buying scenario. So at this very moment, now we are seeing a schematic, which is going to be considered as a distribution schematic. This right here is considered as a distribution schematic because market is now tending to distribute its orders. Now, what ended up happening is that market ended going ahead and placing a huge amount of orders right in this section. And they also ended up selling a huge amount of orders in this section. Now, put it from this perspective. Let's go ahead and say that the market, or let's say institutions or banks, went ahead and put 50 million contracts right here to the buying side. So that pushes the market to the upside. But at the same time, in this very moment, they went ahead and did 10 million contracts to the downside. So when this happens, what institutions start to see is that they start pushing their moves to the downside. Yes, they are in drawdown to an extent at this very moment from here, right here. But since we already understand that this is a distribution schematic, we know that market will come up for a discount. Now, what market does, it usually comes up to a discount to points of interest, imbalance zones, and also accumulations of price. You will be going through that later on the same course that you guys are seeing right now. So those are going to be the following videos. But for now, let me go ahead and explain to you how this works. Market will go ahead and continue going up for a discount. And why is that? The reason why is because they want to get rid of these selling contracts so that way they are not in drawdown. Now, as you may know, the moment that they go ahead and start pushing to the upside, yes, they did go ahead and buy over here once again. So they may have bought another 10 million contracts. So therefore now there's a 50 million contracts overall to the upside pushing. And that is what does this push to the upside. Once market reaches a discount level, an imbalance zone, or a point of interest or accumulation or price, that is when they go ahead and delete the contracts that they had previously that were in drawdown, in this case the 50 million. And as soon as you see those contracts being deleted, market will go ahead and start pushing rapidly to the downside, creating order flow. Now, order flow is going to be another thing that you will be seeing on the course down below. So feel free to go ahead and go through that as well. But one thing that I do recommend, go through these videos in order so that way you can fully comprehend how market institution really works and overall how banks make money in the Forex market. So at this very moment, when market went ahead and did this push to the downside, now they are creating order flow. Order flow is an overall simple word to say of how market is distributing and accumulating their orders. So their first order flow section would have been right in this section. Market comes up, taps into the order flow, and then comes down. Creates new order flows, taps up, comes down, so on and so on. And that is what makes market structure. That is what makes the bullish market structure and the bearish market structure. However, the key point on this is for us to understand when market is distributing and when market is accumulating. So therefore, we know that market is distributing, such as in this point, we will go ahead and get out of the market and look for those overall discounts to continue with the market order flow. And if market is accumulating, which is going to be completely the opposite of what is happening in this section right here. So let me just go ahead and flip this around, see if I can go and flip it around. It's going to be exactly the opposite of what's going on in here. So instead of it going to the upside, it will be going to the downside. So with that being said, guys, I hope you guys enjoy this quick little recap as far as how it is that banks make money in the Forex market. Looking forward to see you guys on the next lesson. See you guys in the next one.